Hey everybody, welcome back to Investing with Wesley. In my previous episode, I talked to you about high reward, low risk investment options, one of them being a tax lien. Now, tax liens can be pretty complicated, but like I already mentioned, they're very low risk when done properly for a pretty good return. So in today's episode, I want to dive a little bit deeper into the tax lien option to give you guys a better understanding of what they are, the pros and cons, and if they're right for you. So with that being said, let's get into it. Okay, so for starters, what is a tax lien? Well, a tax lien is simply a note that the government puts on a property owner who fails to pay their taxes. Now, everyone knows if you're a property owner, you have to pay property taxes. But how does that necessarily translate into you investing into those tax liens? Well, simply, the government wants their money as quickly as possible. So in 28 states, you're allowed to give the money to the government and purchase the lien or purchase the note to that house. So when the property owner who failed to pay their property taxes finally does pay their taxes plus interest, you collect the taxes plus interest instead of the government. Now, obviously that may sound like a huge headache to some of you, but really the question is, are the returns great enough to deal with that headache and deal with all the due diligence and learning how to invest in these things? And that really just depends on what kind of interest rate you're looking for. Me, I'm looking for market level returns or greater for less than market risk. So for less than market risks, I can invest in tax liens and get anywhere from 12 to 18% in interest plus my principal. So similar to bonds being a safe investment because you can collect interest and at the end of the term get your principal back, the tax liens work the exact way. In the sense that if a property owner does pay their taxes in whole plus interest, you get your invested amount, you get your principal back, plus the interest that the property owner had paid to you. Now, what about if a property owner continues not to pay their taxes? They continue to just not pay you. Aren't you on the hook and didn't you lose money, and isn't that a risk? Well, yes, it is still a risk, especially if you don't want the property. However, investing in tax liens gives you the option to foreclose on the property owner in the event that they continue to fail to pay. So if you purchase this tax lien and they do not pay you back with interest in a certain amount of time, then you can elect to foreclose upon that property owner and repossess their home and make it yours. Now, part of the due diligence in picking this kind of investment is to pick a property that has a lien on it in a decent area, in a high value area. You don't want some random lot of land in the middle of nowhere that no one really cares about. You would want something in a municipality, something that you could easily renovate and either rent or sell for yourself. So either way, you get some sort of return for your investment. Either the property owner gives you your principal back plus your interest, or you get the property free and clear. Now, what are the chances that you're actually gonna become the owner of this property and have to foreclose upon them? Honestly, the chances of that happening are extremely low because more often than not, from what I've seen, people only end up getting tax liens in two different situations. The first situation is that the property had finally been paid off and there's no longer an escrow account to pay those taxes for you. So it goes a few months to a year without paying property taxes, and then they get a notice saying, hey, you owe us taxes, and at that point there's already a tax lien out. So whoever the property owner is would pay those taxes, be made whole, and everything is right as rain. The next situation is that someone may have passed away and willed this property over to someone else. Now, they thought it was a gift or a property transfer, not realizing they are now the owner and have to pay property taxes on it or lose the property. Once they realize they have to pay property taxes on it, they'll do one of two things. They'll either pay the property taxes and keep the estate or keep the house, or they'll realize, I don't want to have to pay property taxes on this huge house or this house that we don't even live in, so they'll just sell it. And the great thing about when a property owner sells their property is liens get paid off before mortgages. So you are guaranteed to get your money before the mortgage is even paid back, if there is a mortgage left. So let's recap all the pros before going into the cons. The pros are that it's high returns for little to no risk. Another pro is that you have the right to foreclose in the event that they don't pay and recoup your losses that way. And the third pro is that liens are paid before mortgages and any other obligations. So in the event of a sell, you get your money before anyone else. Now, the cons are that it requires a lot of due diligence and research in yourself because you really want to make sure that if you invest your money in this property and it does go south, that the property is worth keeping or going to be easy to sell or has some sort of value in general. You're also going to want to know at the lien's expiration dates, because just like the property owner has a certain amount of time to pay that note back before you have the option to foreclose, you have an expiration date as well. You have to either get paid and close the deal out that way or foreclose upon the house by a certain expiration date as well, or the whole contract, the whole deal is null and void, and now you truly do lose out on all of your money. Now, I already mentioned the other cons where you have to do thorough research and pick a really good area. I already talked to you about the expiration dates, but one thing that a lot of people don't know, because it's really an unexplored area of investing, is that these are only sold in auctions, and very rarely are you able to just treat it like online shopping where you can put these random parcels into a cart and buy it and be done. Normally you have to go to an auction or an online auction, bid for it, and either bid by increasing the price or bid by lowering the interest that you're willing to receive, and whoever the winner is now controls that tax lien. It's a great way to help you diversify your portfolio into a bunch of different areas of the market, especially areas that aren't necessarily correlated to stocks and bonds. And as I've already been pounding into your head, it's a great way to get better than market returns for less than market risk. I hope you got value in this video. If you did, please remember to like and subscribe, as it really helps this channel get out there. If you have any questions, comments, want something addressed, I have a dedicated Facebook, Instagram, and Twitter account. If you want me to make more detailed videos exactly going through the process of tax lien investing and how to do your due diligence, then leave a comment down below or get in touch with me somehow and I'll be happy to do so. Either way though, the choice is yours, and I'll see you in the next episode.